Okay, good afternoon, everyone. We'll just give people a minute to come in and then we will get going. Hang tight. Right, okay, well, let's kick off and we'll let people trickle in. But good afternoon. Thank you very much for joining us for the latest webinar in our Consumer Duty series. Today, we're going to be looking at the tricky issue of foreseeable harm, hopefully helping to give you some clarity around tricky questions such as what is a harm, when does it become foreseeable, and how much is enough when it comes to thinking about how to mitigate harms. As you know, Consumer Duty is now almost 3 years old, and most firms have been busy enacting their Consumer Duty work programs over the intervening period. But as firms move past the initial wave of obvious fixes, such as rewriting customer communications or tweaking the value of their products, companies are starting to face up to the challenges of the more nuanced areas of Consumer Duty. And with no fixed playbook to turn to, we see a whole variety of approaches from the laissez-faire to gold plating. So over the next hour, we'll be outlining what we see as a proportionate approach to foreseeable harm, sharing some of the good and less good practice that we've seen through our work with companies, and hopefully sending you on your way with some practical ideas about how to improve your firm's approach to spotting and mitigating foreseeable harms. I'm joined today by my colleagues, Tim Hogg, who's the Director of Fairer Finance and a behavioural scientist, and Eve McGrady, who's our Head of Consumer Duty. We'll be making the slides and the recording from today's session available so you can share it with your colleagues. And if you can't get enough of us, then you can also tune into our discussions and all the latest regulatory news and developments in the Fairer Finance podcast, which we put out every 2 weeks. And if you haven't listened before, a good place to start might be with our interview with Nikhil Rathi, Chief Executive of the FCA, which we published a few weeks ago. So in a moment, I'm going to hand over to Tim and Eve, who are going to run you through a short presentation, after which we'll move into a discussion, and then we'll open up to the floor for questions. Feel free to drop questions into the Q&A or even the chat tool at any time during the webinar. We'll try and get through as many as we can in the second half of today's session. If you'd like to talk to one of us about any of the challenges that you or your firm are facing around Consumer Duty, then of course, please don't hesitate to reach out after today's webinar. Right, with no further ado, I'm going to hand you over to Eve and Tim to walk you through the meat of today's session. Eve, I believe you're kicking us off. Over to you.
Thank you very much, James. So yeah, we're going to start with the first obvious question. What exactly does the regulator mean by harm? Well, harm underpins the duty, and I'm sure all of this stuff on the slide is second nature to most of you by now, but just as a quick reminder, we have the overarching consumer principle of acting to deliver good outcomes. Then we have the 3 cross-cutting rules: acting in good faith, avoiding causing foreseeable harm, which is of course what we'll dive into today, and enabling customers to achieve their financial objectives. And then sitting beneath that are the 4 outcomes, which are really the 4 sort of work streams that you'll be most likely doing your day-to-day work on. So we have products and services, so making sure that the products or the service you're selling are designed to meet the needs of customers within the target market. And then price and value, making sure the price that the customer pays for a product or service is reasonable compared to the overall benefits, so the nature, the quality, the benefits that the customer will experience. And then we have consumer understanding, so making sure that customers actually understand what they're getting from the product. And finally, consumer support. Are you supporting customers to achieve their financial objectives? So when thinking about what constitutes a harm, it's often useful to think about what good looks like for the product. So what are the outcomes you want customers to get? And is your product or service set up to deliver that? Is the purpose in line with good outcomes? Is it reaching the right customers, and do those customers understand what they're getting? Can they make good decisions about how they use the product? However, having said this, harms are not always the inverse of good outcomes. So, for example, in the case of investment products, the aim of the product is to provide access to possible returns on your money with a degree of risk. So a good outcome from the product is obviously increasing your savings. However, although it might be a bad outcome to lose money on your investment, that's not necessarily a harm in itself. As long as customers are supported to make informed decisions, they understand the nature of their investment and the risk that they're taking with the product. The fees and charges also represent fair value, and you're appropriately managing their investment. So this is why it's really important to think about the purpose of the product and to consider harm in the context of that purpose. Another thing to consider is that the FCA doesn't always just think about harm in the context of financial harm. So wasting our time and cognitive effort is also harmful, and sludge practices and poor service quality can also act to harm consumers, and also, of course, reduce trust in the brand. For example, say that a customer passes away and their family needs to let their health insurer know and cancel their policy. But there's a very sludgy process to do this. The family ends up making 10 or 15 calls to the insurer before the matter is fully dealt with. This causes immense emotional strain on the customer and a lot of time and wasted effort to let them know. And that would also be seen as a harm in the eyes of the duty. When thinking about the harm, it can also be useful to think about the counterfactual. So let's think about this in the context of an online journey. So in this example, we have a buy now, pay later journey, and a provider didn't include a nudge to set up a direct debit in the application for the product. This means that if customers want to set up a direct debit to avoid missing their instalments at a later date, they have to take quite a convoluted journey to set that up after the first purchase. And that means, in this case, that many customers didn't end up setting up that direct debit. And the impact was that some of these customers then forgot to make their payments, and they were charged late fees, which impacted their credit score. If we think about the counterfactual, if a nudge was included in the journey, more of those customers would have set up a direct debit and avoided the late fees and then the subsequent impact on the credit score. So thinking about what could happen in the counterfactual could also be useful when considering what counts as a harm. Would adding a nudge in the journey minimize the risk that some customers get poor outcomes? The regulator may also focus on harms which damage competition in certain markets. So if it is harder for customers to switch products or to shop around for the best deal, then it can be considered a harm both to customers and to competition in the market. And this is a focus for the FCA. So for example, think about slower ISA and pension transfers. Exit friction in these contexts is seen as anti-competitive. And you can use the 4A's framework, which is here on the screen, to help you think about competition. This is a framework from the FCA and the CMA. So can customers engage in the market? Can they access the information in front of them easily? Can they assess that information and then make effective decisions off the back of that? The FCA takes a proportionate approach to harms, and it doesn't expect firms to identify and mitigate all harms. There is such a thing as insistent customers who make poor decisions despite firms doing everything they can to facilitate good outcomes for them. But what is important in this scenario is having the evidence to demonstrate that you've created the environment for customers to make informed decisions. So if you've done the work to give customers all the information they need to make an informed decision, then the burden can move from you to the customer. So evidence is vital in this case. If the product is not offering excellent value to customers, can you be sure that they're at least making informed decisions to still use that product or still use that service, knowing that they could get a better deal elsewhere? Or if you know that customers are not making informed decisions, can you evidence that despite this, they're getting excellent value from the product? In that context, the burden of proof sits with the firm to find evidence that responsibility for harm sits with the customer. And we're now going to move on to take a look at when a harm becomes foreseeable. So I will hand over to Tim.
So yeah, now that we know what a harm is, when does it become foreseeable harm? Well, with behavioural science, more harm is foreseeable. The Consumer Duty is underpinned by advances in behavioural science. Behavioural science tells us that our decisions are affected by the way that the choice is framed, the choice architecture. And there's no such thing as neutral choice architecture. But the way that we respond to the choice architecture is predictable in many cases. And if our decisions are predictable, then any harm that results was foreseeable. Ultimately, if the FCA's intellectual foundations for the duty and the concepts of foreseeable harm are grounded in behavioural science, then we need to apply behavioural science to think like the regulator and detect foreseeable harm. On the next slide, we've a quick note on whether harm is considered foreseeable. And this sort of depends on whether, in the FCA's words, a prudent firm acting reasonably would be able to predict or expect the harm. So a prudent firm acting reasonably. Now, in our mind, this means analysing the data that you already have on customers and gathering a reasonable amount of additional data where required. So it means analysing things like complaints data. It means analysing data on how people are using the product, on claims, for example, or on whether people are staying invested. It means data on how people are going through the purchase journey. Where are people dwelling the longest? What are people actually understanding from the journey? And so on. Ultimately, if a firm is unsure about possible harms, it might be expected to use customer testing or a limited pilot phase, for example, of a product to build a better understanding of what possible harms could arise. Ultimately, even if a discovered harm is not foreseeable, its emergence might make future cases foreseeable. So the first time it happens, you might think, okay, well, that wasn't foreseeable. But by the second and third times, there's a reasonable expectation that actually at this point it is now foreseeable. On to the next slide. Some firms have ended up spending probably too much time trying to think through every possible scenario and every possible harm, regardless of how unlikely. This isn't meant to be as long as a piece of string. However, it is meant to be a reasonable exercise. And we always suggest starting with the product life cycle and thinking through those different points in the product life cycle, all the way from purchase through to exit. Think through all the different key moments in the product life cycle and what the harms could be at those key moments. And this sort of narrows it down to those key harms which are likely to occur. Now, when we do that, what we find is that many of these possible harms have probably already been surfaced in the complaints data. So sort of going forward, it's about monitoring the complaints data is a large part of it, but it's not just looking at the complaints. We sometimes find that a lot of interesting insight is in the customer inquiry data. So sometimes when a customer calls up or engages through web chat, they might not make a formal complaint, but they might be asking a question which actually indicates a misunderstanding. And when you look at the data, you might realize that customers are systematically misunderstanding something. So don't forget to look at customer inquiry data as well as complaints. Now for a few examples of when a harm becomes foreseeable. So even unusual events may repeat in large books of customers. And we've talked a little bit about that already. Here's an example. So some travel insurance claims are denied due to inadequate medical disclosure at the point of sale. So this could be people not understanding that they need to disclose something about their health, or it could be confusion over what exactly needs to be disclosed. And in some cases, we might see that people don't realize that they need to disclose relatively minor or common ailments, such as common infections. people don't necessarily realize that they need to disclose those, and that can then lead to denied claims in the from the travel insurer later. So the first time this happens, you might think about whether that was foreseeable or not, but by the second or third time you're denying a claim on the basis of a non-disclosed common infection, that probably counts as a foreseeable harm at that point. And then you need to think about what you might be able to do to make good decisions easier for customers when they go through that journey. And it probably involves nudging people in the journey to disclose anything, even if it seems like a relatively minor ailment. The FCA also expects firms to conduct stress testing to understand how the products will perform in different economic environments. The classic one being interest rates. So the example we've got here is interest rate hedging products with structured collars. And these were sold to SMEs, small and medium-sized businesses in the early 2000s. And they were designed to give the borrower certainty of the interest rate that they would owe on their loan, or more certainty at least, within a floor and a ceiling. However, these were structured in a very, very complex way. And actually, if base rates fell to a particular level, the interest rate that the firm ended up owing could end up rising, which is counterintuitive. And so many businesses didn't realize what they were actually signing up to. When rates did fall very significantly in the 2010s, it tripped businesses up. And so it's an example of where non-sophisticated customers were unlikely to grasp the true nature of the pricing and the product. This was kind of foreseeable. The banks that were selling interest rate hedging products were under no illusions about the risk and the product they were selling, but this hadn't been communicated effectively to customers. And in the end, there was a redress event around it. So better stress testing in that product design phase, really making sure that people understand how the product will perform under different circumstances, would have avoided this foreseeable harm. On to the next one. The FCA expects that firms will use the information they have to predict which customers might be on track for poor outcomes. So let's take the example of credit cards. Now, there's arguably a cross-subsidy between those who repay within their 0% offer period and those who do not and end up paying an interest rate on their borrowing. Is it possible for lenders to foresee with a reasonable degree of accuracy which customers are unlikely to repay before the end of their 0% offer period? Now, our view is it's likely to be possible for some customers. So some customers, lenders can probably predict they're not going to repay within the 0% offer period. In our view, this means that there is the potential for a foreseeable harm if those customers end up in persistent debt or repay a significant amount more on their lending than represents fair value. So lenders could make good decisions easier for customers by only lending to those customers who can repay a rate that does constitute fair value, making customers more aware of the costs of slow repayment, especially in the purchase journey where they're signing up for the credit, and then sending more effective communications to those customers at risk of slow repayment once they've taken out the credit card. Finally, we've got another couple of examples from the world of investing of where we can use behavioral science to avoid whiplash moments. So the first one then, first-time investors. When they invest for the very first time, they might not be prepared for the value of their investments to fall. When this happens for the first time, as happened to one of my friends, they then may exit their investments, baking in a loss. So this is a poor outcome. They're doing better off not investing or investing for a very long time. But it's also very predictable, a natural human reaction. You start investing, and then quickly after you've started, there's a moment of market volatility, your investments go down, and you think, oh, weak, I'm not comfortable with this, this isn't for me. Now, that's pretty predictable and foreseeable. So we would say to avoid foreseeable harm, investment providers should make good decisions easier for customers by anchoring customer expectations in the first place, ensuring that they have sufficiently long-term investment horizons and making sure that they're prepared for the emotional cost of volatility when it hits. And that will help people either not invest if it's not right for them, or invest with the right expectations and stay invested for the long term, which will lead to better outcomes. Similarly, first-time investors might not understand that investing in concentrated portfolios is more risky than well-diversified funds. If you have £100 to invest and you buy one particular stock on the FTSE 100, that is more risky than buying a tracker in the FTSE 100, for example. Now, for some customers, if they don't realize that, they might not invest in well-diversified funds, and they could end up with a portfolio of investments that doesn't match their risk profile. And what might happen here is that these customers experience more volatility than they expect or are prepared to experience. So this again might mean that people withdraw their money early. It might just mean that people have more volatility in their investments than they're prepared for. Either way, it's kind of foreseeable. Investment providers can avoid this foreseeable harm by informing customers about the benefits of diversification, and then by making diversification easy. If the default option on an investment platform is to invest in a well-diversified fund and a low-cost fund, then that will reduce the risk of foreseeable harm. And with that, I'll hand back to Eve.
Thank you very much, Tim. So our final section before we open up for some discussion. So now that you have some tools to identify foreseeable harm, what steps does the regulator expect you to take to prevent these? Well, first, it's important to understand what the scale of the harm is, and there are a few different ways to do this, but essentially, in our view, it's about understanding the size of the harm in terms of who is affected, the impact, and how likely it might be to happen again. So understanding the size of the harm will help you then to work out what is a reasonable and proportionate response. So we can see this on a chart here. So we're looking at number of people affected on the x-axis and cost on the y-axis. And remember, cost could be financial or non-financial. So you may identify harms that affect most customers, but have a low impact in terms of cost. So this would be the cross on the far right-hand side of the screen here. An example of what this might look like, so low interest rates on easy access savers. So many people are affected by being on legacy rates that are poor value, but the financial cost to each individual customer may be reasonably minimal. They may be losing out on some interest each year. It could be a negligible amount. Then at the other end of the scale, you may also identify harms that have a significant cost to customers, but only affect a few individuals. So this could be rejected life insurance claims, for example. So the financial cost of this may be large, not to mention presumably the non-financial emotional strain of that distressing experience. And the way that you respond, the way that you act to mitigate these two harms will be different. So by taking into account those factors, you can start to think about a proportionate and reasonable response to the harm. And you may be able to mitigate the harm by sending out a communication to your customers. Perhaps in the case of those people sitting on those low saving rates, that will be an appropriate response. Or in some cases, you might have to think about more permanent changes to the product itself. And the regulator will expect to see evidence that you've considered the options that we've got on the screen here to demonstrate your considered approach to mitigating the harm. And it might expect that in some cases you adjust the price or the features of the product, or perhaps look at the distribution model. How is the product reaching customers? How are you communicating with customers through your written comms or perhaps through the online journey? And in many cases, the regulator will expect that you apply a combination of these approaches to help you mitigate the harm. In some cases, the right way to mitigate the harm will be to get rid of the product feature which is causing harm. So, for example, in the case of credit cards, the complexity of fees and charges for taking out cash may cause harm to customers who don't understand the costs. And in some cases, simplifying the costs can help to mitigate the harm. And as you can see in the example on the slide, the complexity around differing interest rates and when these apply is what we're looking at here. So customers may not understand that they're charged interest on the cash from the moment they withdraw it, from the moment it comes out of the machine. And firms have responded to this foreseeable harm by reinstating some consistency in the charges so that those customers know what to expect when they take out cash. In some cases, it will be more difficult to mitigate harm, particularly where the harm reveals perhaps wider industry issues, and addressing that harm could lead you to become uncompetitive in the sector. In these cases, it's about recording the evidence that you've uncovered this identified harm. And perhaps if you're a larger firm, you'll have the resources to commission an expert to look into this issue. And indeed, we have helped firms with this in the past, doing independent research on a particular industry issue to uncover that harm. But otherwise, just make sure that the FCA is aware of this harm and that you raise awareness around the issue. We have also noticed changes in response to the duty in terms of some of the comms sent to customers, so a response to those harms that have been identified. Some firms have been introducing new communications. And in this example from Nationwide, you can see there's a clear prompt here to act to avoid the savings auto-rolling into an account paying a poor interest rate. So some work done there to mitigate that potential harm. And others in the market are following suit, so making sure that customers are aware that they could be getting a better deal. And this is another example from a Monzo email. Contacting customers at key moments in the life cycle is another way to show that you're doing what you can to wake up customers and prevent the foreseeable harm. So in credit cards, some providers are now introducing more proactive comms, contacting customers at the end of the offer period. And firms are using different ways to engage customers, so not just relying on written communications. In insurance, we've seen some more innovative approaches, so efforts to explain the complexity of cover and make sure that customers have the best chance of buying a product that is suitable for them through these interactive videos. And finally, I'll hand over to James for our wrap up before we move into discussion. Over to you, James.
Okay, thanks very much, Eve. So just on the next slide, we've got a handful of points for you to take away. Ultimately, it's important to do, some kind of thought exercise around the potential harms that could arise at different stages in the customer life cycle. So obviously making sure that you've mapped your customer journeys and thought through potential harms that could arise. You obviously need to mine your complaints data and the existing MI that you have, inquiry data as well, as Tim mentioned. We've come across firms in the past actually really efficient at monitoring complaints data, but weren't logging the inquiries that were coming in a sort of systematic way that would allow them to analyze trends. So, using all of that data that's coming into your organization, to work out where the problems are arising, where potential harms are arising, and then on an ongoing basis, collecting and monitoring the right MI moving forward to validate that consumers are achieving good outcomes and to spot any possible emerging harms. Now, as Tim says, obviously not all harms are foreseeable, but the emergence of a particular scenario sort of may mean that a harm becomes foreseeable in the future. And then, of course, where possible harms are identified, put in place reasonable mitigations to prevent them. And, that might include, as we've mentioned, more or better communications, a change to product features or pricing, or a change to customer support options. And remember that there's often more than one right answer when it comes to solving consumer duty challenges. Almost always there is. So basing your decision on evidence, on data, using customer testing where appropriate, and acknowledging the potential pitfalls in any course of action that you commit to. And that is what compliance and good practice looks like. Record your discussions and decisions in committee minutes, being honest about, some of the things that perhaps you weren't able to prevent or mitigate, but being open to having done, as much as you reasonably can. So that's the end of our presentation. As I said, that will be made available to you afterwards. And I promise we're now going to move into a short discussion between the three of us and opening it up to the floor for any questions. So please do start putting any questions you've got into the chat or the Q&A now, and then we'll try and get through as many as we can. But we're going to start off amongst the three of us. Eve, you're kicking us off.
Thank you, James. So I want to pick up on something you mentioned in your opening remarks. You said, you know, people are now grappling with the more challenging aspects of the duty. How well do you think firms are handling this in aggregate?
Yeah, we see a really mixed approach and mixed performance. And I think when consumer duty first got going, firms sort of got to grips with the really easy stuff, like, okay, we know that our communications are not clear enough. We need to prioritize them. We need to start improving the ones where we acknowledge they're not in great language or designed in a way that's effective. Maybe we need to add some more communications. But then, when it comes to some of the challenges that fair value assessments have thrown up, or the sort of the whole concept and process of consumer duty has become better embedded in all corners of the organization, it started to raise some of these grey areas. And I think some firms have kind of lost the wood from the trees in it all. Some firms are sort of downgrading those consumer duty programs and saying, well, I think we've got this now. It's kind of business as usual. And others are thinking, actually, this is much bigger than we initially thought it was. And I think we're going to need to double our efforts to try and, to try and be compliant here. So we're seeing a whole array of processes. But I think in most firms that we interact with, there's still quite an uncertainty about whether they're getting it right or not. And I think it's really sort of down to the culture in the firm as to whether or not they're sort of scared of the regulator and have decided that, they need to keep, swimming hard and, doing whatever they can to prove that they're meeting it, versus those who are being a bit more laissez-faire, thinking, actually, we've looked around us in the market, we can see what's changed. And we can see what hasn't changed, and actually we're in the middle of the pack, so we're probably fine. But what we do see is that although the FCA is not being quite as vocal about consumer duty sort of externally, behind closed doors, we know that many firms are having some quite stiff conversations with their supervisors about compliance with the duty, and we've seen the use of VREX and OIREX, to get firms to kind of, pull up their socks. So, it's certainly not advisable to be resting on your laurels, thinking that consumer duty is sort of fizzling out, because that's very much not the case.
Thanks, James. And yeah, Tim, I wanted to pick up a bit on the behavioural science stuff, because I think it's really fascinating. We talked a bit about behavioural science making more harm foreseeable. Could you perhaps talk a little bit about how firms have been embedding some of the principles of behavioural science in response to the duty?
Yeah, so I think at its core, we apply behavioural science to make good decisions easier for customers. And actually, a lot of the time, that isn't rocket science. When you look at your journeys and your communications, and you try to put yourself in the shoes of someone who has limited time, has limited experience of financial services, fundamentally doesn't find insurance interesting, people, in other words, that don't work in the sector, when we put ourselves in those shoes, we can actually see that there are lots of ways we can make good decisions easier. By communicating more clearly, for example, and not using jargon, or by putting in the right amount of friction in the purchase journey, keeping things really fast and easy, but then slowing people down at the key points where they need to really understand something in order to get the value from the product. So I think it's through those sort of things which, it can sound complicated, but actually a lot of the time isn't that complicated when you look at your journeys. And I guess the other thing would be on the product design and pricing, sort of really understanding how people are going to be using the product, and following the money and following what customer behaviors drive profitability. And when you do that on the fair value side of things, you can also sort of unlock those areas of where you're not entirely comfortable that people are definitely getting fair value. Maybe there's foreseeable harm going on due to the pricing as well.
And we spoke a little bit about proportionality here, but I can see we've got a great question from someone in the chat. So they said, really interesting examples of good practice, but do we have any advice or guidance for smaller firms who perhaps don't have that kind of comprehensive MI? Maybe they've got lower budgets and lower resources. What would you say in response to that?
So I guess if I just start on that one, I think there's a couple of really good examples of smaller firms who do manage to look at their journeys and comms, even though they are smaller. So it could be, I think the FCA shared an example of where they called up 2 customers every other week and asked them to play back sort of the key messages from a communication. And that's really low scale, small scale testing, but actually it's helping to uncover where people misunderstand things and where there might be foreseeable harm. We've worked with other small businesses where the testing starts by asking the people who come in on work experience or for internships what they understand from things and go from there as well. So there is an understanding of proportionality here. That being said, the FCA is very clear that even small firms need to think about foreseeable harm and make sure that they're not overlooking things in the data that they do have.
I think another route that's open to small firms is trade bodies and professional standards bodies, that provide lots of resources, in some cases sort of, off-the-shelf support to help firms, work out what do they need to do. If you're going to go through the motions of becoming a chartered financial advisor, for example, there's lots of steps you need to go through as a firm to get corporate chartered status. And the CII is kind of shifting that to marry with Consumer Duty. So, some of these professional standards bodies are thinking, how can we create a path to smaller businesses to give them the comfort that they're compliant with Consumer Duty, and help them see the value in the membership fees that they pay us. So but as Tim said, at a more practical level, if you're trying to do it on your own, you don't have that support, then it's still the same kind of stuff. If you're a small firm and you don't have many complaints, then you're obviously going to be expected to be thinking very carefully about the complaints that do come in. And also there are some great resources out there for free. You can look at ombudsman decisions, and the ombudsman is actually going to be publishing more regular updates moving forward about the kind of themes that it's seeing emerge from its complaints. And I think once they start doing that, that'll be a really rich source for kind of small businesses to keep their eye on and just think, is there something here for us that maybe we can put a bit of extra friction in to try and prevent that happening to our customers.
Brilliant, thank you, James. We've got a question here about kind of the beauty of hindsight, I suppose, in relation to identifying foreseeable harm. So someone says, keen to hear your thoughts on how firms should respond when a harm is identified many years after the original sale. To what extent is a prudent firm acting reasonably caught by the wisdom of hindsight? So maybe James or Tim, do you want to come in on that one?
Well, I think that it's a fair challenge, right? That ultimately hindsight is a wonderful thing, and I think you have to go back and think, is there something we could reasonably done, and could we have seen? I mean, motor finance is a great example there, isn't it? Where I think honestly the market could have spotted that. The fact that they're not disclosing commissions and the commissions are very high, and in the worst cases, the dealers are adjusting the commissions for their own benefit. That's certainly not in customers' interest. But at that time, everybody was doing it in the market, and it felt very much consistent with how the market was operating. And I think 10, 15 years later, when the Supreme Court says that absolutely wasn't okay, everyone's like, oh yeah, okay, well, but yeah, that wasn't okay. So I think Consumer Duty isn't retrospective. That's one thing that's really important to do, to remember. And so things that happened pre 2023 when the duty came into force, are not going to be sort of litigated under the foreseeable, you could have done something to prevent that harm. What's really important for firms is that they've got the right processes in place today to be able to say in 20 years' time, okay, this harm did emerge, but here are all the things that we thought about at the time and all the processes we went through. And although we didn't spot this one, you can see that, that wasn't because we were negligent as a firm, we didn't have the right culture. We made all reasonable attempts to try and prevent harms.
Great, thank you. And we've got another question here sort of aimed at, what is a reasonable approach and how do you, I suppose, prioritize your action to mitigate a harm? So someone here says that they're working in a communications team and they're continually having conversations with risk teams about terms that customers find difficult. And they give the example of ISA subscriptions. This term repeatedly tests poorly in customer understanding testing. And the pushback that they keep getting is about consistency. So consistency with HMRC and internal consistency, because not everything can be changed at once. So Tim, what's your response to this? They said, my view is at a decision point, it's better to prioritize customer understanding and then push for change in the long term.
So we would say the same thing. So where there is jargon, and ISA subscriptions definitely counts as jargon, much better to go for plain English, plain language versions of those words. And if you can do that throughout your communications at the same time, all the better. Obviously, understand that some of these things need to be phased. Where consistency matters is where people are likely to be shopping around and comparing providers, or where there's a particular tax rule, for example, in this case. There can sometimes be justification for explaining that what you mean is also known as this jargon by other companies or by HMRC, for example. So you could say, this is the term we use. You might also see the term subscriptions being used by others. And so explaining it in that way enables people to understand, if they're going to then compare with what HMRC says or what ChatGPT says that HMRC says, they're then going to be able to understand it. But definitely don't let that hold you back from radically changing the language to be more understandable. Often it's that incremental change that actually, once you've done that to the top 100 jargon terms or whatever, your comms will be radically different and test much, much, much better.
And sort of a slightly different angle, this question around fair value assessment. So James, coming to you on this one, have you got any guidance for how we can ensure we're capturing demonstrable evidence of foreseeable harm in terms of fair value assessments in particular?
Well, I mean, in a fair value assessment, firstly, you want to be ensuring that you're probably benchmarking yourself against the rest of the market, so you understand where you sit and looking for any red flags there. So, if your product is not quite as comprehensive as some of the others on the market, then, is your price commensurate with that? Perhaps your price is a bit higher than average. Is that justified because you've got evidence to show you've got better service levels? And, that exercise of benchmarking yourself on product, on price, on service is a really great starting point, and also a way of sort of detecting potential foreseeable harms. Because if you start to see that your fair value equation is slightly out of balance, you might think maybe we need to change the pricing, maybe we need to improve the product features, maybe we need to do something here to improve our service. So that's one great starting point when you're doing a fair value assessment. And I think then also making sure that you're using all of the range of MI you've got to understand what kind of outcomes customers are getting. And I mean, we've talked a lot already about complaints data, but I think it's so rich and it's the most obvious place to turn to when you're thinking about foreseeable harm, because these are harms that have arisen, or perceived harms at least. And so, making sure that you're studying those trends and that you've got the right level, of analysis going on in your complaints data is going to take you a long way. And as I said, in my last answer, if you're a smaller firm, there are still other sources out there. Obviously the FCA is publishing updates on a regular basis about good and poor practice in different areas of consumer duty, sector by sector or theme by theme, and that's all available on their website. And then you've got ombudsman updates and ombudsman decision databases that you can search. So, I think, if you're looking at a good range of data internally, and you're doing that, that right benchmarking process, those are great places to start for, for building a good evidence base around where there could be harm and where you need to focus your attention.
The only thing I'd add to that is to think through that concept Eve was presenting to us earlier around where the value feels like it might be relatively low. Is there really good evidence that people are making informed decisions? So if when you do your fair value assessment, you identify those pockets of customers or those products where the value is relatively low, then make sure you've got the evidence that people are making informed decisions about whether they purchase the product and then how they use the product. And if you've got really good evidence that people understand the trade-offs, people understand the product, they understand the pricing, and they're making decisions in that light from a position of full understanding, then actually you can sort of assure yourself that that's not a foreseeable harm. So that's one way to narrow it as well when looking at these things. And actually using that frame hopefully reduces the amount of work as well, because you can sort of zoom in on those cohorts of people where the outcomes might be poorer. In general, we often say, follow the money. Which type of customer is generating the most profitability for your product line or your business? And if you sort of zoom in on those and make sure they're making informed decisions, then that's a reasonable degree of assurance that overall there aren't sort of these massive foreseeable harms lurking in the background.
And yeah, something that you mentioned, James, in terms of being able to analyze your complaints data. If a firm does see, okay, we've got an emerging harm here coming through in the complaints data, how quickly would you say that the regulator expects you to respond to that? Because, firms will, of course, have different resources available and different things they can do, but how quickly is the response expected?
Yeah, I mean, I think, to go back to those nauseating words, proportionate and reasonable, it's going to come down to how serious is this? How many people is it affecting? Obviously, to pluck an example out of real life recently, if you're Lloyds Bank and, your customers' transaction data is showing up in other customers' banking feeds, that's very high level of harm that you're going to need to rectify immediately as quickly as you can. If there's a more theoretical harm which has manifested itself on one occasion and you think actually this could happen again, I think again it goes back to some of those points you were talking about earlier. What is the scale of that harm? Are there any quick things that you could put in place? Maybe just adding a line to communications or sending an email to help sort of prevent that happening again. But in some cases, the fix might be making changes to your IT systems. And if you're a large life insurer that's been around for 100 years, you may have some very inflexible systems. And whilst you may have identified the harm and doing what you can to mitigate it, the sort of big solution is going to be in replacing those legacy systems, and that is going to take time. But again, as we said in the presentation, and as I said in those kind of summary notes at the end, the important thing with the consumer duty is to be able to acknowledge these problems, to see them, to do what you can, in the short run to mitigate firms, even if that's not the ideal outcome, and then work towards perhaps, the better, longer term, more expensive one. But if you're a large firm, you can be, facing into hundreds of these at any one time. It's clearly not going to be possible to, to be doing thousands of different work streams to mitigate every possible potential harm, and that's why prioritization is so important in consumer duty. That those very high levels of harm for a small number of people, or lower levels but that are going to affect a very large number of people, certainly those are the ones that you're going to want to prioritize.
Great. And I think, we're talking a lot about sort of financial harm here, but we did also mention the impact of non-financial harm. We've got a question in here saying, have we seen any strong examples of how firms quantify non-financial harm? Tim, do you want to take that one?
I think we often challenge firms to do a better job of quantifying non-financial harm. So I'm not sure I've seen any brilliant examples of it already being done, but there are ways of thinking through. So if you think about customers' time being wasted, you can definitely quantify that, and you can quantify it for a small number of people or a large number of people, and it might inform what you do. I think the really interesting examples are where the harm is so great that actually trying to quantify it would sort of diminish it in a way. So you can think of some things around, say, health insurance, where decisions become a matter of life and death. And actually, at that point, you kind of don't really want to quantify it in pounds and pence. You want to think through the ethical implications for your business as well as the brand implications. And hopefully those cases are not so regular that you need to aggregate them and you can sort of take each one on its own. But there are definitely lots of cases out there. I guess also privacy, as James was just mentioning, with banking transactions being shared with people. There are lots of cases where you sort of need to add up the number of people affected, but you don't necessarily need to put the harm in pound terms when thinking through whether it's a foreseeable harm and what to do. Sometimes redress might be appropriate, and you need to think about what would be an appropriate sort of pound and pence compensation, but you don't need to leap to pound and pence at the start. Sometimes that sort of diminishes the emotional harm or whatever that might be going on.
And just to kind of bring James back in on that point, we talked a bit about the regulator not expecting you to prevent all harm, but what's the point which firms can sort of reasonably say, okay, we've done enough to mitigate the possible harms that we have identified?
Yeah, I mean, this, obviously there's not a right answer to this question, which is the point to some degree. And, as we keep sort of saying, compliance is about showing that you've thought through potential problems and put in reasonable mitigations for them ultimately. And, there's going to be different approaches to this. I mean, I think, we take the view that if you've communicated really well with your customers, and when I say communicated well, that's not just about writing letters in plain language or having nice, clear customer journeys. It's about communicating multiple times, the same message multiple times in different medium. So you can say, okay, well, we know there's a really key moment in this product life cycle. It's a fixed rate mortgage. You're going to go from quite a reasonable rate to something that's a lot higher, that's going to send your monthly payments up hundreds of pounds. And we know that in all likelihood, you don't want to be on that higher rate. So we're going to write you the letter. We're going to write you some emails. We're going to send you a text message. And in the case of, small building societies, we're actually going to ring you up and tell you that your rate's coming to an end. At that moment, there is nothing more you can reasonably do, as long as you're sure you've got the right details for the customer. If you're Barclays, you're not going to ring up every fixed rate customer coming to the end of their fixed rate term. But if you're the Newbury Building Society, maybe you will do. And we certainly have worked with building societies, not the Newbury. They're just the first one that came to my head that have done that. So if there is that extra mile that you can go and you think, actually, this is not, it's only 50 customers a month for us, and, the number that haven't done anything within a few days of their rate coming to an end is very small, we're going to ring, why not do that? But we take the view that at some point, if you've communicated really well, you've designed your products well, where the kind of pitfalls are, and you communicate that really well, and you look reasonable compared to other products in the market on price, on features, on service, then responsibility does have to shift to the customer at some point. And, as long as you've given them all the information they need to make an informed decision, taking into account any vulnerabilities, any different needs they might have, then there's not that much more you can do reasonably. You should keep coming back to that because technology may change what is possible moving forward. But, I think it's just asking yourself that question. Is there anything more we could reasonably do here? An extra communication we could send that might move the dial? And if there isn't, and you think your product is fair and people keep, sort of taking these decisions which you think are not economically rational, it may be just that they've decided it's okay. I know I'm going to pay a bit more, but I'm coming to the end of my mortgage. My mortgage is actually quite small. I'm not strapped for cash. The difference from me going from 5 to 8% is going to be £50 a month, and I don't care. Well, that's economically irrational, but I think that's not. At that point, it's an actively passive customer who is saying, I can't be bothered. My time is not worth it, and I think that's fine. But you need to have got to the point where you can say, we're pretty sure these are those customers. Long-winded answer.
Thank you. And yeah, just to kind of link into what you were talking about in terms of, what we might see as technology improves. One final question, which we'll take quickly, to Tim. Are we seeing firms adding to, removing, amending metrics, monitoring harms as their data matures and trends are better understood?
Yes, absolutely. So we're seeing firms add different metrics in as it becomes obvious which metrics really get to the essence of the consumer outcome. We're seeing firms removing metrics because you don't want information overload for your senior leaders. And if you only ever add stuff in, it becomes just completely overwhelming. And we're seeing a lot of thought also go in not just to the metrics, but also the thresholds. So a lot of firms sort of set up the metrics and set up, RAG thresholds, red, amber, green. Several years on, were those thresholds set in the right place? Did they flag red or amber when a major event happened? Or are they always going amber when actually we're okay with the outcome? So a lot of thought going into thresholds at the moment, as well as the metrics.
Brilliant. Thank you, Tim. I think that is just about all we have time for. So I will hand back to you, James, to wrap up.
Okay. Well, thanks very much, Eve. Some great questions in there. But yes, that's all we've got time for today, unfortunately. But as I mentioned at the outset, we'll be making the slide and a recording of today's session available so you can watch it back or share with your colleagues. And of course, if you'd like to talk to us about any of the challenges that your firms are facing, please do reach out and we'd be happy to set up a call. We'll be back with one more webinar before the summer holidays. Topic to be decided. If you've got things that you'd like us to cover, then please do get in touch with us and let us know. But keep an eye out for that. We'll be announcing that shortly. But that's all today. Thanks so much for joining us and have a good rest of your afternoon. Bye for now.